So welcome everyone. This webinar is part 2 in our series of 4 webinars that are designed to support you during this very turbulent financial time for nonprofits, and particularly for advocacy nonprofits. This webinar is about important accounting concepts that are specific to the crisis. And after the webinar itself, we will be sending out the slides, the recording, and a glossary, which we hope will be really helpful to you. I also want to make sure that you know that on your calendar, the next webinar is next Thursday, and it is at so July 2nd at 1 p.m. And that we will be doing a third webinar, I think the following week, but we are picking the final date and time, and we'll get that one and the registration out shortly. So the other thing I want to remind you, if you have not been taking advantage of the opportunity to meet individually with Michael, I really encourage you to do that. The partnership members who have already done that have said it's been extremely valuable to them. I've heard that now from 4 or 5 people, and it is free to you. It is a service from the partnership. We do structure it in 2 parts. The first is a half hour after you've sent him information, and I have the list of what you need to send him. So he's reviewed it before you meet and can talk with you about what you need to do. And then you go back and prepare the documents that you and he agree make sense and send those to him. And then you have a half hour to go over them with him. If you think you need more than that, let me know and we'll make it possible. Our goal is to make sure that your organizations survive the pandemic and the recession and continue to be in a strong position to benefit, work for kids. And so we are doing everything we can to help you get there. And I believe that Mike's support for your financial management is a critical piece of that. And everything I've heard from members who've already taken advantage of his consulting services tells me that for those organizations, that's been true. So please, if you haven't already taken advantage of it, do so. And the easiest way to do that is to email Polani Cortez Vilas. You should have her email. If you don't have it, email me and I'll connect you, and she'll get you the list of what you need to get him and get you scheduled to meet with him. So now let's turn to today's webinar. Mike?
Okay, thank you so much, Deborah. Can you hear me okay?
Sorry, one more thing. I forgot to say that we will take questions today. I will be moderating them. Please put your questions in the Q&A, but if you have general questions like I'm having trouble with the audio, or can you please add my name to the list that is getting the sign up for working with Mike, or I have this document I want to share in response to something Mike said, all of that can go in the chat box. Questions for Mike during the webinar, please put in the Q&A and I will moderate them over the course of the webinar. There. Now it's your turn, Mike. Sorry about that.
Oh, no worries. Thank you so much. So we'll go ahead and get started here. I'm going to sort of skip over the introductions. I'm assuming we've done multiple webinars together and you know who I am. I do want to remind you that my contact information, but also work through Deb and Polani. It's very important for a number of reasons for them to coordinate and be aware of what's going through, because we're trying to help out multiple organizations at the same time. But my email address is, please save it here. I do these webinars in classrooms all this time, and I hear from people from 10 years ago, 10 months ago, 10 days ago. So stay in touch. I like to be there for you. Also, one other reminder that this website, sc4nonprofits.com, is where we're posting blogs and new information every week. We've already posted, Deb, 2 pieces of information that are pretty interesting. Number one, and I would like to put a plug in for this. Not a plug, it's a free bit, but we're almost at June 30th. A lot of nonprofit organizations have June 30 year ends. And I think that with almost every group I've met with so far has had a June 30 year end, and so we have a full quarter of COVID-19, and we're coming up on a year end, which is always a high, a high touch point. for organizations. And I wrote a brief blog on this, how to message, getting ready for that, some thinking, and that's up on the website here. And I would encourage you to go there. There's some new information there. My partner there, Ben Takis, and I are posting at least 2 pieces every week. And the glossary is in the resource section, but Deb and Polani are going to send that to you later afterwards. And so you just need to sit back. This is going to be the most exciting thing you're going to do all day. No, but it is finance, but we're going to go ahead and go through things together. The good part about today is we're going to go through a lot of touch points. Some you're going to go, oh, I know that. Let's go on to the next. Others you're going to go, boy, that's really interesting. Because Deb, I think like with a lot of groups, there's a lot of misunderstandings, or even like, I like to say myths. People think it's this way, but it's not really. And a lot of things that touch base with IRS, GAAP, General Accepted Accounting Principles isn't always logical, but we have to, doesn't mean we don't have to follow those rules. And this will help going later on. I think this will really help. And these are the way I look at things. These in the glossary, they're not just cut and paste definitions, because there's thousands of them out there. I try to make them more explanations and definitions. So before we get started, I think we can get rid of a number of myths here, Deb, by going through what makes a nonprofit different from other for-profit type of entities, because a lot of people take this for granted. And if you ever, a lot of this, we're going to look through the eyes of starting up a new entity. If you ever been involved with that, and I'm sure you will be in the future, we're always spawning different entities and things to go through these questions. So I'm going to start with some interactive questions. And because we don't have too many on, is it okay if they just take their mic off, or would you rather them chat through the chat? We didn't talk about that. They could just respond if they would like. But
given that we do have fairly few people, that would be fine.
I would almost prefer that. I think we can be.
Let's do it.
So why don't you just everybody take your mics off? Let's do this. There's no wrong answers, but when it comes to nonprofits and for-profits, are they mostly the same or mostly different? And if you look at it, I know it's a big question, look at it through the eyes of like an accountant, revenue or expenses. And if you like, you can even turn your camera on if you want. Are they mostly the same on the revenue side, or nonprofits mostly the same as for-profit companies on the revenue side, or mostly the same on the expense side? Which do you think? Are they more similar to for-profits, nonprofits? On the revenue side or the expense side? Any responses?
I'm trying to get people unmuted here. We're having a little technology issue, but Jennifer and Mary are unmuted now, and I'm still working on Emily here.
Okay. So what do you think? Most likely the same on the expense side or on the revenue side as for-profits? It's showing it muted to me.
Huh.
This is Jennifer. Can you hear me?
I can hear you, Jennifer. Yes.
I would definitely say on the expense side, they seem the same. I'm trying to think about if I'd say on the revenue side.
You're 100% correct, because we're almost identical on the expense side, and we have similarities on the revenue, but a lot of differences because we have revenue streams that they don't have. Okay, good. Deb, I just want to let you know that Jennifer is unmuted, but everybody else is muted, from what I can tell.
Mary, can you say something just so we can make sure we hear you?
Mary's good.
Okay. And Emily, I'm guessing you're trying to stay muted, because I'm having trouble unmuting you. I'm not sure what's going on there.
Okay, well, we'll keep moving.
Oh, Mary says she's on her desktop but doesn't have a mic. I'm not sure what's up. So Mary, if you want to respond, pop it in the chat and Polani or I will read it out loud.
Okay, thank you so much. So where we're really different, as Jennifer just said, is on the sources of funds is where we're different. We get support, which is contributions, donations, in-kind gifts and things. And we get grants, which are like a contract, but it's a different set of deliverables, and we're going to talk about that later on. But those two large chunks of money, for-profits don't get. They don't get support contributions, they don't get grants, okay? The other thing that separates us in my mind is that, we're driven by a volunteer board, okay, where for-profits are wholly owned or stockholders. And then we have to go after and we have the opportunity to go after and get tax exempt status, which is good. Okay. So let's go to the next slide. So why do nonprofits exist? And I just like to spend a moment here and talk about this. And I said, we exist because it's hard. If you think about this, if a nonprofit entity has an activity that they can do, that everybody loves, they can get as much money as they want for it, and they have hardly any expenses on it. That's a fantasy because it never happens. They would have a huge surplus. If you could do that on a regular basis, it would be a for-profit entity. Because anything we can do to make money at, we're going to do that. So if for-profit entities can't fill a role that needs to be filled, where's the first place most people look to for support and help? And where they go next is, federal, state, local, municipal level, and that's where we get support for education, roads, infrastructure, safety, you see. So we have for-profits at the top, if government fills in at the next level. Okay, so if the for-profits can't do it and the government can't cover you, what's left? Excuse me, us. That's why we exist, because it's hard. And the way I grapple with this, sorry, 1 minute. The way I grapple with this is that oftentimes for nonprofits, it's a push-pull. If you were to put your most mission-critical program out there, it doesn't mean that program brings in the most funds. A lot of times, the most mission-critical program is hard to fund, and that's why you're needed. You know what I mean? And then we do other programs that attract funds that are important to mission, but not a direct connection. And I call it mission drift. You know how we accept a grant or a project over time? And, it's a good funding source, but it's not like really what we want to do, And so, we might be drifting off our mission a little bit. So we're balancing that all the time. Okay, let's go back to the beginning. If you ever set up and started a nonprofit entity, and keep your mic unmuted if you can, I just want to have a couple of quick questions. We set that nonprofit entity up, even before we look at tax exempt status or anything, as a corporate entity, okay? Why is that important to set up a nonprofit as a corporate entity? It can be set up as a nonprofit, a trust, a nonprofit corporation, and such. And we set them up, these three factors are there when we set them up. Public good, in perpetuity, and we need good core business practices. But having this corporate structure around that, and what do you think is my favorite answer of these three down here when we have a nonprofit set up? What's the most important? Take a guess. Anybody unmuted? What do you think? Public good, in perpetuity, good core business practices. Any responses?
Mary says public good.
Yeah, almost everybody always picks that. Super important, not my favorite. Two left, okay? Everybody looks at me and they say, oh, I'm an accountant. They think of business practices, which is important. But to me, the in perpetuity is the most important thing, okay? When someone asks you about your nonprofit organization, the most important thing you can say, because you've been working so hard for so long, is to say that we've been around a long time. And we are structured in a way and we performed against mission in a way that has helped us, enabled us to be around a long time. Stating that you've been around a long time does not happen by accident, okay? Only good organizations have staying power. The next thing you want to say out of your mouth, and this is why corporation is so important, is that we are in position to be around a long time and to help a lot more people in the future, okay? And that you have to be both relevant and vibrant and safe and healthy, okay? And so organizations that are constantly teetering on the brink, it's a tougher thing for people to support. But to me, one of those big emphasis of overall financial health and stability is to say that you have something in place that's going to be around for a long time. Good core business practices, just like for-profits, we got to follow most of these. So let's compare them real quick. Good accounting systems, that's important. Okay, and I would actually argue it's more important for us than for-profits, because if we have a glitch in our accounting systems and if there's something bad happens, It's a lot harder for us to get people's confidence and trust back than a for-profit because we're completely transparent and visible, and we can't afford those glitches. Building reserves, sort of unique to nonprofits. For-profits, it's hard for them to build retained earnings because they get taxed on that. Nonprofits, it's hard to build reserves, but we must do it. We've been talking about that. We're going to talk about that even more in the next webinar. Okay. Do we have to worry about building up too much reserves? No. There's nothing in the tax code that you would lose your exempt status if you built up too much reserves. It's a fantasy anyway. But it's self-monitoring, because if people gave you money, donated to you, and you didn't spend any of it, they would stop donating because they're really supporting your efforts, not just the ask. The next two go together, moral fiber and transparency. Do for-profits have it? I'm not going to really talk about it. Nonprofits, that's our religion. We have to embrace it. You've heard me say this on other ones. High-performing nonprofit organizations embrace transparency. I also think high-performing organizations, nonprofits, have a high moral fiber, and we need to be able to display that at all times. Okay? So this is why we're here. Accounting policies and procedures, for-profit, nonprofits, the same. Okay? We both need them very much. Okay, can nonprofits seek a profit? Yes. We shouldn't be spending every penny every minute. We need to build up a safety zone. That's where operating reserves come from, and that's what we need to do that. Now, in setting up nonprofits, there's two big silos. Let's go over on this side first, the 1024 form silo, the public good. There is over 20 code sections, 501c sections for different types of nonprofit that are non-charity, okay? And so you have C6, trade associations, okay? C7s are social clubs, okay? C4s are advocacy groups and things and such, and there's many others, okay? And the difference here is they're exempt, and they're exempt from one tax and one tax only, which is federal income tax, okay? Everybody thinks they get sales tax exemption, all these other things. No, they don't even get state income tax exemption. But most states, if you're approved under the Form 1024 for a C6, 74, or whatever, most states will follow those, and you'll be exempt from state income tax and nothing else. Property tax, no. Real estate tax, no. And I can keep going. Now, the leap of faith is over to here, the 1023 form. These are for publicly supported 501c3 entities. And I believe, Deb, everybody we have on today and anybody most likely listening to this would be a C3, a publicly supported entity. Okay?
That's correct. Now, some of them also have C4s and need to know how to, need to manage both. And some of them partner with C4s. And that's something I bring in the Alliance for Justice to make sure the legal lines are followed. But to be our member, they have to be a C3.
Yeah. That's called a complex structure when you have more than one entity and one C entity involved. That IRS refers to that. And that is a very typical structure. Especially for larger organizations, we'll see 5, 6, even 7 entities there. And a nonprofit can even own a for-profit, okay? And there's lots of examples of that around the country. So what separates these publicly supported entities? The C4 is doing advocacy work. The C3 is a publicly supported group. And these things are set up, in my mind, for 2 reasons and 2 reasons only. Reason number 1 is to get at funds that are hard to get at as a non-C3. Contributions, grants, and such. Most grant making or giving entities cannot grant to a non-C3, okay? And that's especially for federal, state, local, municipal, okay? All those type of entities. Most foundations, private foundations, follow that same rule. And the other reason I like to set up C3s is because of C&T, confidence and trust, that the general public is used to hearing, oh, we're a 501c3 foundation or whatever. They understand that that's, to them, it's at a higher level than a non-C3 over here. The way the two work together is that they can form a great partnership because they can do advocacy work at the same time as publicly supported type work, and the two together. And so a non-C3 will set up a C3 so they can get at funds and do some programs and partner with different other types of organizations that they wouldn't be able to as a non-C3. Okay, I want to break a couple important myths here. In order to, it's really hard to lose a 1020, a 1024, but a C3 under 1023, we get checked every year on Schedule A of the 990. You have to meet what we call the public support test rules. Okay, so when you get a chance, pop open your 990, go to Schedule A, go to the second page, and you'll see a percent there. And please write this down. Okay, in order to be publicly supported, you need at least 1/3 of your funds coming from the general public. That means 2/3 of your funds can come from not the general public. And if everybody can unmute your mic, I'm going to ask a couple of questions here. Okay, question number one is, if 2/3 of your funds can come from not the general public, what IRS calls disqualified persons, who are they? And it seems counterintuitive that you can get 2/3 of your money from the group that's not public. But question number one is, who or what are disqualified persons? Does anybody want to take a shot at that? Any answers, Deb?
No, but let's give them a moment. And Jennifer, I'm not sure why I can't unmute you, but if you type in the chat box, I will share your response, or you can text me if you want at 202-213-8981. And after we've waited, Mike, I want to make an additional comment about this when you're done on this point about public-private.
Okay. So just watching the timer, any comments yet? Who would be who or what is a disqualified or considered a disqualified person? There's two categories of them. And
we're taking verbal responses, and welcome.
Please go ahead and just unmute yourself and chime in. We have enough a size group, we can do that.
Yeah, we're not seeing it, so I think we'll just go ahead here on that.
Okay. So disqualified persons fall into one of two categories.
Wait, sorry, Emily said private citizens question mark. Mary said private citizens question mark.
Good, yep, and they're all eligible, but there's two of these citizens, there's two groups that will be considered disqualified persons. So it's good we're doing this step, okay? You need to think about this because it's very important, and then you need to go back to your 990 and look how you've been reporting this. The first group I look to are what we call interested parties, people who have a direct connection to the organization, okay? So for example, board members are considered disqualified persons because they're involved in managing the organization. They have a fiduciary responsibility. Okay, Deb, you answer the question for them. Ready? Do you want board members to donate? Please don't let me down. Do you want board members
to donate? Yes.
No, you're supposed to say we're begging them to donate. That's the answer.
Someone else was responding as well. Who was that? Who wanted to chime in?
Oh, this was Ann. I just said yes.
Yes. Yeah. And isn't it you get a little bit of a negative mark if you say all your board members didn't donate, right? Remember, we're always touting that, especially for C3s, all the board members are donating and all that. It's really important. But they're considered disqualified persons, the board members, because they're managing the budget. They're managing the organization, so they could ultimately have control over their donations. We still want them to donate. And remember, 2/3 of their money for the organization could come in. So if you were a $3 million organization, you can get $2 million from disqualified persons and not be in trouble. Okay? Now, I will tell you two things. Thing number one, don't hold your breath on this one, because here's why. I have never seen an organization get in trouble from getting money from interested parties. We usually don't get enough money from them, board members and such. Now, it's not just board members who are interested parties. If a member, Mary Smith is on your board and Mary Smith has a company and the company makes a donation, that's considered as it's coming from Mary. So do you have that? So the board member, any business connections to the board member would be considered disqualified. If the board member's spouse makes a donation, even though the spouse isn't on the board, that's considered a disqualified person. If a board member's spouse's company makes a donation, that's considered disqualified. If a board member's children makes a donation, a board member's children's company. So can you see? Don't ask me how many generations, but it's basically the family unit and any business connections to that would be considered like a single unit, okay? Now, we usually don't get too much money for them. So where's the area we have to really watch carefully? That's this other big chunk of disqualified persons. Anybody want to take a guess?
You can speak or put it in the chat box.
Anybody I can pick on? Any mics? Jennifer, I see your mic is unmuted. Can you hear me?
Yes.
Yeah. So Jennifer, let's say I walk up to you on the street and I want to give you a $1,000 check. Are you happy? Say yes.
Yes.
Okay. What if I added a couple of zeros to that and I want to give you a $100,000 check? Are you more happy?
Yes.
Yes. What if I added a couple more zeros? I want to give you a $10 million check. Now you're forgetting the name of your board members, right?
Right. That probably gets a little bit more trickier.
Yeah. So can you see where I'm going with that, Jennifer? The other set of disqualified persons are large donors, because by the size of the gift, they would have undue influence, even though they don't sit on your board. You say, hey, look, I'm giving you $2 million, but I want you to do X, Y, Z for me or something. You see what I mean?
Yes.
But you're not going to bend over backwards for a $100 gift. So the second chunk of funds that are disqualified persons are large gifts. And that's why we track those through Schedule A. Now, remember, you can get 2/3 of your money here. And with a little work, you can go down to as low as 10%. Now, the 990s, Deb, that have been sent to me over the last week or two, most of them are in the 80-90% range. Most groups are getting their money from a pretty broad set of groups, and they're not getting one or two gigantic chunks of money, and it's okay. But other groups teeter on that because they might be relying on large chunks of funds, and so you can sort of see that. Okay.
So that's what I actually wanted to comment on. I think this is a higher priority for partnership members right now because you can't do your live events. And the reason that matters is that you were probably getting enough individual donations through your live events to at least meet the 10% benchmark and probably often the 33% benchmark. But if you're surviving on a handful of large grants from foundations and you're no longer getting your individual donations, all of a sudden that becomes a problem and you have to track it. And as I'm sure Mike's about to tell you, we averaged this over 5 years, and hopefully this pandemic will not be a problem for 5 years, but you should just have this on your horizon. I had to manage this for the partnership because we deliberately do not solicit grant donations from private individuals because we don't want to compete with you. So we get by on relatively few large grants from major foundations, and we meet the 10% test. We don't meet it's more complicated than that, but we're fine. We are legally fine, but we have to monitor it carefully because we don't get individual donations from private individuals. And until we get through the pandemic, you guys should monitor it too.
So let me give you a couple of what I call Mike Gelman guidelines. So number one, when someone dangles a large check in front of you, step number one is you grab it out of their hands and you run to the bank as fast as you can, okay? Step number two is while you're running to the bank, you need to do two things to think about. Thing number one is do the 50% rule. So if someone were to offer you $100,000, what's 50% of 100? It's $50,000. So in order to have that 100 and not hurt your public support test rules, you need 50,000 coming from other small sources to offset that, or from unrestricted, general public sources. Okay, that's number one. And number two, as Deb referred to, we can go down to with some special tests down to 10%. And in certain categories, there's a way out through unusual gifts. And the fourth way is this is a rule that's averaged over 5 years. So and to do some simple math real quick, if let's say you have $1 million budget, over 5 years, that totals to $5 million, correct? There's a 2% rule. 2% of $5 million, 2 times 5 is $100,000. So anybody who gives you more than $100,000 over 5 years in total would be in that 2/3 bucket. But remember, you can still get 2/3 or even more of your monies from them. And then we track them through, and that's what Schedule B is, where we have to list gifts over 5,000 so we can sort of track those. Okay.
Mike, we have a question from Mary. How large is large? Is it a percentage? And you've just sort of answered that, but I want to give Mary a chance to put in the chat box if she has an additional question about it. While she's doing that, I do want to say that the first 2% of any foundation grant can count as public support. So it's not that that is completely out of the bucket. And
Right.
for organizations like ours, which are primarily getting, in fact, almost exclusively getting large grants, that 2% of each large grant is a critical difference. Mary is fine. We can keep going.
Okay, good. So it's really a 2% test, and you get to keep the first 2%. But usually there's a way out. The only place I've seen people get in trouble with this is they're not watching. And I've never seen anybody not get in trouble because there's so many ways. IRS really wants to help you here. But if you don't watch and you don't take contemporaneous, which is actions to document and do certain things, let IRS know, your auditors know at the time of the gift, it's much harder to defend 4 years later when you have a problem. Okay? And so
Mike,
you really want to watch that. Yes.
Right. The other thing that I wanted to say about all of this is you may historically have been counting, and appropriately so, funds from donor advised funds as public contributions. And that has been true, but that may change. They're considering changing that regulation so that it isn't. So if the way you've met this test is by large contributions from donor advised funds, just be aware that may change in the future. To the best of my knowledge, it hasn't yet.
Yeah, and you have to look behind the funds, because here's my question. Deb, I'm going to do this question with you because I can see you. Ready? If you get, let's say you're a $1 million organization, and for the first time in your life, you get a $500,000 grant from the federal government, okay? Do you have a problem with the support test rules?
No,
Why?
government grants count as public.
Why? Because where does the government get its money from?
The taxpayer.
Taxpayers. Okay, the same thing. You get a $500,000 grant from a publicly supported charity, it is public money.
Right.
You get $500,000 gift from a private foundation, which has failed or didn't, I hate to say fail, because most private foundations just go there. They don't want to have anybody else. You know, they're just a family trust and they're right there. But if it's private foundation money, then it's not public. So the first thing we do, because a lot of people call something a foundation and we don't know what it is. I've even seen for-profit foundations out there, you know. So you go and check. If it's public money coming federal, state, local, municipal, that's public money. If it's coming from another publicly supported group, that's public money. That's why you have to look at the donor advised funds to see where it's flowed through.
Mike, let me add to that. This is pretty technical, but I'll just share it. If
Okay.
you're working out a group grant proposal, you may not always want to be the prime grantee who does the contracts with other groups. If you've got a problem here, one way to solve it is to get a re-grant from the primary granting group, which is a public charity, because then their money to you, if it's a contract, counts as public money and helps you meet your goal. So one of the ways to finesse this, if you are close to your edge, is to not be the primary grant on a group grant. And so now that's really technical. I'm just trying to get you to understand why you want to watch this, particularly when your individual donations are down.
Let me put a different spin on what Deb said. Don't listen to exactly what she said, but listen to what she said. Here's what I mean. No, because there's a gazillion examples.
Right.
And I'm trying to think. I can't think of one where when we've been proactive at the time of the gift, there's always a way around it. But when you wait 3-4 years later and the forms have been filed, 990s and all that, you have very limited things that you can do to fix, correct, or take. And it's a shame because all funding sources are usually powerful. And you owe that to your donors and people who are giving you funds to have done the research ahead of time. You don't want to make it hard for them or an embarrassment down the road. So you see what I mean, Deb? So my analogy of your story, which is one of a gazillion stories, is if you're thoughtful, there's really some unique things we can do. So that's why I wanted to spend a few minutes here, because it's really a shame, Deb, when you go in and you find out in 2016 this happened, and you go, oh my God, if they just would have done A, B, and C, which would have cost them nothing, it would have been okay, you know?
Yep.
And so that's the story there.
Right. And the only reason we're even raising this now is because your in-person fundraising events are being canceled, and all of a sudden your individual small donations are drying up. So you got to watch this.
yeah, the numbers can come around and change pretty quick. So we're going to do a quick introduction to the glossary. This is going to be sent to you by Deb and Paulina right after, and you can also get it off the website. I just want to let you know that the table of contents for this is broken up into these 6 areas. It's not short, but it's not super long. It's 15 pages long. But I think of this as a reference. Please don't read it beginning to end unless you really have a boring life, okay? But you can go back and check. Again, we worked hard on this to get explanations in there over what I call a real world basis. And what we're going to do now is we're going to go through some of the terms in there that I think are really relevant, Deb, to just what's going on today, but also it'll help on the TAs and such, okay? Some of these sections you're going to go, been there, done that, I'm okay, and we'll just move through. One of these is a fiscal year. I think most people understand the concept of a fiscal year. It's not always on a calendar year, okay? It is always 12 months, okay? And it almost always ends on the last day of a month. I've seen very few that don't run that way, okay? And so you can start any month of the year. But as I just said, you know, we're coming up on June 30 year ends. If you took all the June 30 year ends and all the 12/31 calendar year ends, you would get probably, I'm just guessing, 70 to 80% of the nonprofits are in one of those two. There's a lot that line up with the fiscal federal year, you know, which is September year ends. But I've had year ends in March. I've had year ends in February, January, basically any month of the year. Okay. Any questions here? Because each one of these, we're going to go through about a dozen of these. If there's anything, you can just unmute, mute, and jump in or do a chat. Okay. Another one I just want to spend a couple minutes on is generally accepted accounting principles. You should not read these. It's actually dangerous to read these. But your accountants will be watching over these things, but you'll hear us refer to these all the time. GAAP, generally accepted accounting principles. They're standards. It's mostly built around so we get a standardization of recording of transactions and how we report those, okay? There's separate principles from the Financial Accounting Standards Board, FASB, GAS, Generally Accepted Accounting Auditing Standards, you know, and things. You'll hear these terminologies being thrown out there. GAAP, Generally Accepted Accounting Principles, is built around a couple of core principles, and one of the key ones in there is the difference between accrual basis and cash basis accounting. So I would like to stop here. Everybody will probably come across these both. Most organizations are one or the other. And I want to go through a quick definition. But before I go to the next slide, does anybody want to take a shot at what on cash basis, a description of what cash basis accounting is? Anybody want to take a quick shot at that before I go to the next slide?
You can talk or you can type it in the chat. We're monitoring it.
Okay. So I'm just going to go ahead. Okay, Deb?
Yeah, we're not getting a response here.
Okay, good. So here's a quick analysis of cash basis. It basically mirrors your bank statement. Okay.
When funds are received is what we got from Mary.
Yeah. And it's not just received, it's really received in the bank, put in the bank and coming out of the bank. Okay. So your bank statement becomes your financial statement. Okay. So if you got a check in and you're like June 29th and your year end is June 30th, and you don't put that in the bank until July 2nd because you didn't have time, okay, that's going to be recorded next year on a cash basis. So your bank statement becomes your financial statement. The pros, as you see over here, are it's simple, very low cost. And for very small 990 yen nonprofits that are under $50,000, you know, it works. Because to me, cash-based, accrual-based is part of the internal accounting control systems. And like any internal control, we want to make sure the benefit of that work outweighs the cost of it. So for very small organizations, it works. I did a lot of work for a long time with National PTA. There's 23,000 subunit PTAs. The average elementary school PTA has a budget of less than $2,000. Doesn't need to be on a complicated accrual basis. It's not going to be much different. But there are a lot of cons, okay? So Deb, let's pretend you're the manager of a ABC nonprofit generic organization, okay? You just had a decent year. It's December 29th, and if you were to close your books that day, you would have a $5,000 surplus cash basis. But sitting on your desk is an American Express bill for $8,000. If you pay that bill in the next 2 days, it'll throw you into a loss. If you don't pay the bill, you'll stay with the surplus, and you pay the bill 3 days later in January. You know what I mean? So you can manipulate your bottom line. And the same thing with money coming in. You go, oh, I'm happy with my $5,000, and the next day you get another $2,000 check. I want that money for next year. So you can, again, by putting it in and out of the bank, you can control. So it's open to manipulation. Now listen to this very closely. What I don't like about cash basis accounting, for all the things I said, is this: the perception of it scares me. Because if you walk up to someone on the street and just say, oh, we're a nonprofit organization, we do this and this and this, and, oh, that's amazing, or you do this. Oh, by the way, we're a cash basis. And all the air comes out of the balloon. They just want to pat you on the top of the head like you're a little puppy and say, nice little organization, you're very cute, but they're not going to treat you seriously. Because they know, remember, perpetual organization can be around a long time. Deb? Oh, we might have lost Deb. I'm assuming everybody.
I think I'm back, Mike.
Okay. Okay, good. So I'm going to keep going. Can you hear me okay?
Yep.
Yep. Okay. So that's all I wanted to say about cash basis accounting. The flip side of that is accrual basis accounting. And here what we're watching is what we call the matching principle, okay? That money, revenue